If you arrive in Britain through one of its international gateways, the country performs a kind of economic magic trick. From the windows of a fast train into central London, you pass glass towers, luxury apartments, and corporate logos that belong to the most powerful financial institutions on the planet. The streets are lined with premium cars, global cuisine, and storefronts that suggest abundance without limit. From this angle, the United Kingdom looks less like a declining power and more like a polished global hub that successfully transitioned into the modern age. But this image is not a reflection of the country as a whole. It is a carefully concentrated illusion. What you are seeing is not a national economy operating at full health, but a hyperdense financial enclave that has separated itself from the society around it. London does not function as the capital of a productive nation in the traditional sense. It operates more like a city-state embedded inside a much weaker host economy. To understand what has gone wrong with Britain, you have to leave this bubble behind and travel outward to places where the glass towers vanish and the consequences of decades of economic choices become unavoidable. In the post-industrial towns of the Midlands, the former coal and steel communities of the north, and the aging coastal regions that once supported maritime trade, a very different country exists. Here, the signs of decline are subtle but persistent. Empty high streets, fragile local services, and wages that barely move from one generation to the next. These regions are not suffering because their people lack skill or ambition. They are suffering because the economic system that once gave them purpose was dismantled and never replaced. For much of the 20th century, Britain's economy was anchored in production. It built ships, engines, machinery, textiles, and steel. Its industrial network gave rise to a broad middle class and tied regional prosperity to national success. But by the late 1970s, this model was breaking down. Chronic underinvestment, labor conflict, and rising international competition exposed structural weaknesses that had been ignored for decades. Britain entered the global economic crisis of the 1970s unprepared and overextended, culminating in the humiliation of an international bailout that shattered confidence in the old system. The response to this crisis was not reform, but reinvention. Rather than modernizing industry on the scale seen in Germany or Japan, Britain chose a different path. It decided to abandon the role of producer and reposition itself as a global financial intermediary. This shift accelerated dramatically in the 1980s, when financial deregulation transformed the City of London into one of the most permissive capital markets in the world. Money flowed in from everywhere. Banks, funds, and foreign elites discovered that Britain offered something uniquely valuable: light regulation, legal stability, and a cultural openness to wealth concentration. The transformation worked, at least on paper. Financial services expanded rapidly, tax revenues surged, and London became one of the most important financial centers on earth. But the success carried a hidden cost. As finance grew, it began to crowd out everything else. Capital chased property and financial returns rather than factories or research. Talent followed money instead of engineering or science. The currency strengthened in response to capital inflows, making manufactured exports less competitive abroad. What emerged was a distorted economy tilted heavily toward asset management rather than value creation. This imbalance hollowed out the productive core of the country. Britain did not simply lose factories. It lost the incentive structure that rewards long-term investment. Companies learned that shareholder payouts mattered more than modernization. Hiring cheap labor became easier than upgrading equipment. Short-term financial performance replaced long-term industrial strategy. Over time, this mindset became embedded in corporate culture and public policy alike. The consequences are visible in Britain's chronic productivity problem. Workers are not unproductive because they lack effort or intelligence. They are unproductive because the tools, systems, and infrastructure around them have been allowed to decay. Productivity is ultimately a function of investment, and Britain stopped investing. Businesses found it rational to extract value rather than create it. The state, reliant on tax revenues from finance and property, tolerated this erosion because the surface numbers still looked acceptable. Privatization accelerated this process by converting essential national assets into financial instruments. Infrastructure that once existed to support economic activity was repurposed to generate dividends. Utilities, transport, and public services were restructured to maximize short-term returns, often at the expense of resilience and maintenance. Debt replaced investment. Ownership shifted abroad. Strategic control weakened. Britain increasingly resembled a platform economy designed to generate yield for investors rather than stability for citizens. This model appeared sustainable until it encountered systemic stress. When the global financial system cracked in 2008, Britain absorbed the shock more severely than most advanced economies. Its outsized banking sector transmitted losses directly into the public balance sheet. The rescue that followed preserved the financial system but permanently altered the state's fiscal position. From that point onward, economic policy became defensive. Growth slowed. Public investment was cut. Long-term planning was sacrificed to short-term budget management. The austerity era that followed did not restore confidence or competitiveness. Instead, it eroded the foundations of future growth. Local governments lost capacity. Transport networks deteriorated. Education and training systems stagnated. Public institutions were stretched beyond design limits. Crucially, austerity reinforced the private sector's reluctance to invest. When the state retreats from development, businesses rarely step forward to fill the gap. Risk increases, horizons shorten. Capital waits. By the mid-2010s, Britain had entered a state of economic suspension. It was not collapsing, but it was no longer advancing. Living standards plateaued. Wealth accumulated unevenly. Growth depended increasingly on asset inflation rather than innovation. The economy functioned, but it no longer worked for most people. The promise that effort would be rewarded had quietly expired. This underlying fragility set the stage for the political shock that followed. The decision to leave the European Union did not create Britain's economic problems, but it exposed and intensified them. Trade friction, regulatory uncertainty, and reputational damage struck an economy already struggling with low investment and weak productivity. The impact was not explosive, but corrosive. Confidence drained slowly, decisions were deferred, capital became cautious. Brexit also shattered the perception of Britain as a predictable, rules-based environment. For decades, its greatest economic asset was credibility. Investors trusted its institutions, its legal framework, and its political culture. That trust was undermined by years of instability and policy reversals. Once credibility is lost, it is expensive to rebuild. Markets demand compensation for risk, and that compensation comes in the form of higher borrowing costs and lower investment. At the same time, the country's dependence on property deepened into an obsession. Housing ceased to function primarily as shelter and became the central pillar of personal wealth. Planning constraints limited supply. Demand grew relentlessly. Prices detached from wages. Capital flowed into real estate because it was protected, scarce, and politically defended. This locked wealth into unproductive assets and created generational divisions that now shape every major political decision. Younger workers face a system that taxes income heavily while inflating asset values beyond reach. Older asset holders benefit from rising prices and protected incomes. The state increasingly serves to stabilize this arrangement rather than challenge it. The result is a society optimized for preservation, not progress. Britain today is not poor, but it is misallocated. Its resources exist, but they are trapped. Its talent remains, but it is underused. Its institutions survive, but they strain under accumulated neglect. The country continues to function because it is drawing down the capital of the past. Infrastructure built decades ago. Reputations earned generations earlier. Systems designed for a different era. This is what the end of empire looks like in economic form. Not collapse, but gradual contraction. Not sudden crisis, but managed decline. A nation that consumes what it once created, hoping the bill can be postponed indefinitely. The most destructive force in the modern British economy is not a recession, a foreign rival, or even political incompetence. It is a market that is supposed to support economic life, but has instead consumed it from the inside. Housing in the United Kingdom is no longer a background condition of prosperity. It has become the central organizing principle of wealth, politics, and power. And once housing takes that role, everything else begins to fail. In a healthy system, homes are places to live. They are durable goods that provide stability so people can take risks elsewhere, start businesses, change jobs, or move to where opportunity exists. In Britain, housing stopped playing that role decades ago. It became a financial asset first, and a social necessity second. Once that transformation occurred, the economy quietly rewired itself around protecting property values at all costs. The roots of this dysfunction lie in planning laws that transformed land from a productive input into a scarce political prize. Britain adopted one of the most restrictive development systems in the developed world, not by accident, but by design. Instead of setting clear rules that allow building when conditions are met, it created a discretionary system where almost any development can be blocked by political pressure. This turned construction into a slow, uncertain, and expensive process. Over time, It ensured that supply would never keep pace with demand. As population grew and household sizes shrank, the number of homes failed to adjust. Prices rose not because houses became better, but because permission became rarer. Landowners captured enormous unearned gains simply by holding property. Entire generations learned that the safest way to accumulate wealth was not innovation or entrepreneurship, but ownership of scarce land near successful cities. This distorted incentives everywhere. Banks preferred mortgage lending to business lending because property collateral was politically protected. Households poured savings into deposits instead of investments. Governments quietly encouraged the system because rising house prices created the illusion of prosperity without the hard work of productivity growth. Property inflation replaced wage growth as the main source of perceived wealth. But this illusion carried devastating side effects. High housing costs act like a tax on labor. They drain disposable income, suppress consumption, and reduce mobility. Workers cannot easily move to where their skills are most valuable. Firms cannot scale because employees cannot afford to live nearby. Cities that should be engines of growth become bottlenecks instead. The British economy suffers from this more than almost any comparable country. Its most productive regions are effectively sealed off by housing costs. Opportunity exists, but access does not. This traps people geographically and economically. It also traps capital. Trillions of pounds sit embedded in residential property, generating no exports, no innovation, and no productivity gains. It is wealth that cannot move and therefore cannot work. This housing trap interacts dangerously with another long-running trend: demographic aging. Britain, like most developed nations, is getting older. But unlike others, it structured its economic and political system to overwhelmingly favor asset-owning retirees over working-age contributors. Pension protections, property wealth, and political influence concentrate power among those no longer participating in production. This creates a one-way transfer of resources. Younger workers face high effective tax rates, student debt, inflated rents, and stagnant wages. Older cohorts receive protected incomes, rising asset values, and expanding claims on public services. The state enforces this imbalance because it reflects electoral reality rather than economic logic. The result is a society that systematically underinvests in its future to preserve its past. At the same time, the workforce itself is shrinking, not primarily because of retirement, but because of illness. Britain has experienced a sharp rise in long-term sickness that has quietly removed millions from economic participation. This is not simply a medical problem. It is an economic feedback loop. Years of underinvestment in health infrastructure, combined with rising stress, insecurity, and poor living conditions have increased demand for care, just as capacity has fallen. Long waiting lists mean treatable conditions become disabling. People who could work with timely support are pushed into inactivity. The labor supply contracts, productivity falls further, and inflationary pressure rises. The health system becomes both victim and amplifier of economic decline. As fewer people work, tax revenues weaken. As revenues weaken, investment falls. As investment falls, services deteriorate. This cycle is self-reinforcing and politically difficult to break because its costs are spread slowly and unevenly. Faced with a shrinking domestic workforce, Britain has relied increasingly on migration to sustain basic services and headline growth. Migration fills gaps in healthcare, education, logistics, and hospitality. It prevents outright collapse. But it does not resolve the underlying productivity problem. In fact, it often postpones solutions. When labor remains abundant and relatively cheap, firms delay automation and process improvement. When population growth boosts GDP totals, governments avoid confronting stagnating GDP per person. Migration becomes a stabilizer, not a transformer. It keeps the system running, but it does not fix its design flaws. All of these forces converge into a form of economic paralysis. Britain is not poor in aggregate terms. It is misaligned. Capital flows into assets rather than production. Labor is taxed but not empowered. Policy protects incumbents instead of entrants. Risk is punished, and inertia is rewarded. This creates a political economy where reform is theoretically possible but practically blocked. Any serious attempt to fix housing would reduce asset values and anger homeowners. Any attempt to rebalance pensions would provoke backlash from a powerful voting bloc. Any attempt to increase public investment would require borrowing or taxes that markets scrutinize harshly due to lost credibility. So the system persists. Not because it works, but because changing it is costly in the short term and beneficial only in the long term. Decline becomes the default outcome, not through conspiracy, but through incentives. Britain increasingly resembles a country living off reputation rather than renewal. Its legal system, universities, culture, and history attract global capital and talent. But these strengths are not converted into broad-based prosperity. They function like inherited wealth, producing returns without regeneration. This is how advanced economies fail in slow motion. Not through dramatic collapse, but through erosion. Living standards slip relative to peers. Infrastructure decays quietly. Young people adjust expectations downward. Ambition migrates outward. The end of empire, in this sense, is not about lost colonies or diminished military power. It is about losing the ability to organize resources toward the future. It is about mistaking stability for success and mistaking asset inflation for growth. When economies stop growing, they do not simply freeze in place. They adapt in ways that are often invisible until the consequences are unavoidable. The danger for Britain is not that it will suddenly collapse, but that it will normalize decline. That it will come to accept a lower standard of living as the natural order of things, rather than the result of choices that can still be changed. History shows that stagnation narrows political options. When growth is strong, governments can afford compromise. Rising incomes smooth over inefficiencies and allow mistakes to be corrected over time. When growth disappears, every policy choice becomes a zero-sum fight. Protecting one group requires extracting from another. Stability turns into rigidity. Reform becomes betrayal. In that environment, states rarely reduce their own scope. They look elsewhere for solutions. Sometimes the extraction is obvious, through higher taxes or visible spending cuts. More often, it is subtle. Inflation quietly erodes savings. Currency weakness raises the cost of living. Regulation shifts risk from institutions to individuals. What feels like bad luck is often policy operating through indirect channels. Britain is already experiencing this form of quiet adjustment. Living standards are falling not because wages are collapsing, but because costs are rising faster than incomes. Public services are not failing all at once. They are thinning out, becoming slower, harder to access, and less reliable. Wealth remains visible, but it is increasingly disconnected from work or production. This is what late-stage decline looks like in developed economies. Not chaos, but imbalance. Not revolution, but resignation. A society where success depends more on timing and inheritance than contribution. Where the future is managed rather than built. And yet, none of this is inevitable. Britain still possesses the raw materials of renewal. It has world-class research institutions, deep capital markets, global cultural reach, and a legal system that underpins trust. It has energy potential, geographic advantages, and human talent that continues to compete at the highest level internationally. These assets have not disappeared. They are simply underutilized. The barrier is not capability, but politics. Reversing decline would require confronting the systems that currently define British stability. It would mean building enough homes to make property affordable, rather than scarce. It would mean shifting capital away from passive assets, toward productive investment. It would mean rebalancing generational obligations, so that work is rewarded, rather than penalized. It would mean restoring credibility by choosing consistency over spectacle, and long-term planning over short-term appeasement. Most importantly, it would require accepting that the economic model, built to manage the aftermath of empire, has reached its limits. Finance alone cannot substitute for production. Asset inflation cannot replace growth. Reputation cannot indefinitely cover for underinvestment. Empires do not end when flags are lowered or treaties are signed. They end when the institutions designed to manage abundance are asked to manage scarcity instead. Britain crossed that threshold quietly. The question now is not whether decline is happening, but whether it will be acknowledged. Nations that recover do so when they stop defending the present and start preparing for the future. That moment usually arrives only after the cost of delay becomes undeniable. Britain is not there yet. It still has room to choose. But time, once lost, does not return cheaply. The end of empire was a historical event. The end of economic relevance is a decision made, repeatedly, year after year, through avoidance and inertia. Decline is not imposed. It is allowed. And the longer it is allowed, the harder it becomes to reverse. Hey everyone! If you enjoyed this video and want to stay updated with more insights on finance, make sure to subscribe to my channel, Financial Coin. And don't forget to hit that bell icon so you never miss our latest videos.